ETF investing strategies. ETF investing is picking up steam as more and more demat accounts are opened by retail investors. Individuals like to take the direct route and do investing by themselves. Are you such an individual investor who is looking to engage in the market more hands-on? Then ETF investing can give the most bang for your buck if you act smartly. In this video, we go into ETFs or exchange-traded funds as an alternative investment strategy. ETFs are sort of the best of the both worlds, as they have the benefits of both passive as well as active listening. Moreover, certain strategies can benefit you the most while investing in ETFs. These can make large contributions to your long-term investing returns. So this video is here to give you a bite-sized boost on ETF investing and smart investing strategies. So, hit the like button and let's deep dive into ETF investing. Chapter 1. What are ETFs? ETFs or exchange-traded funds are simply a type of mutual funds that trade directly on the market. This means they are a hybrid of shares and mutual funds. If it seems a bit confusing, let's take an evolutionary road to understand ETFs. First and foremost are your basic vanilla stocks, technically known as common equity. Equity or stock means a piece of partnership in the underlying company. A bigger version of this is an index like Nifty or Sensex. Indices are an average score created from the stock price of top companies in the market. You, as an individual, can invest in stock directly or go to an asset management company, or AMC like HDFC AMC, or Axis AMC that manages mutual funds. Mutual funds contain money pooled from thousands of investors like you. This creates economies of scale and large investment at cheaper costs as possible. It also provides the advantage of active management where the AMC hires an expert manager who can maximize returns and minimize risks. ETFs are just slightly different versions of mutual funds. While for mutual fund purchase or sell, you need to approach an AMC. An ETF can be directly purchased or sold from your exchange, like a simple stock. So ETFs are mutual funds that can be traded very liquidly like stocks. So let's take a look at the ETF pricing mechanism. ETFs have two values. One is trading value and the other is NAV, or net asset value. NAV is the actual value of underlying securities after deducing management costs. So when you buy an ETF from the exchange, you buy it at a trading value, which is usually the same as NAV but fluctuates a little based on demand supply. It is notable that in this case, you actually buy ETF from a previous investor. On the other hand, purchasing directly from the AMC will effectively create the units like regular mutual fund units. To know more, let's look at various types of ETFs. Number 1. Equity ETFs. These are ETFs created only from the equity asset class. As per SEBI regulation currently, equity funds need at least 65% equity holding, though most funds hold 90% plus equities. Number 2. Commodity ETFs are also very prominent in India. Currently, only 2 commodities are allowed for ETF investing, that is gold and silver. They hold physical gold-silver for all ETF investors so that investors do not have to worry about the security of holding these precious metals. Number 3. Bond ETFs consist of debt from government or corporate sources. These are similar to debt mutual funds but traded openly as ETFs. For example, SBI 10YG SEC ETF holds only the 10-year bonds from the Indian government. Number 4. Sectoral ETFs invest in a particular sector as the name suggests. This includes automobile, healthcare, technology, and more. Number 5. Currency ETFs invest in the currency as the underlying asset. For example, holding US dollars can be profitable as Indian rupee is a depreciating currency. So let's move on and get into the advantages and disadvantages of ETFs. But before that, if you're liking this video so far, drop a like and press the subscribe button for more such content. Chapter 2. Pros and cons of ETF investing. ETF investing is not free from downsides like any other security or instrument. Let's discuss the pros first. Number 1. Low cost. ETFs are very low-cost investment options compared to mutual funds. The latter has a much higher expense ratio that includes the cost of active management. Since ETFs in India are passive investment vehicles, they provide a low-cost expense ratio to the tune of 0.2% per annum. Number 2. High liquidity. Since ETFs are traded on the exchange, they can be bought and sold at any time, which provides higher liquidity. Even though mutual funds can be redeemed anytime, they have exit loads to dissuade investors from doing so. Liquidity is also much more required when investing in bonds that have quite a small secondary market. Number 3, index investing. ETFs provide a much more flexible option to index investing. Investing in indices by itself is difficult due to high fund requirements. Index mutual funds are good, but they have lower flexibility. On the other hand, the cons of ETF investing are: number 1, tracking error. ETFs are passive investments, which means they either follow a benchmark, as in the case of BEES, or a benchmark exchange-traded scheme, or they have a set portfolio that cannot be changed, like in the case of CBSE ETF, which only includes public sector enterprises. Investing in these means the ETF will not always follow the target benchmark with 100% accuracy due to time lag, weight distribution, and other factors of demand-supply. Number 2, brokerage fees. ETFs will also be subject to your respective brokerage fees in terms of trading and delivery. Mutual funds usually do not have such charges. Number 3, volatile. ETFs will observe fluctuations in the market due to the liquid exchange of units. The volatility is also invited by traders looking for arbitrage opportunities. So, if you're looking to invest in ETFs, you need to be aware of these pros and cons beforehand. Chapter 3, Top ETF Investing Strategies. Now, let's finally discuss some ETF investment strategies for becoming an intelligent investor and maximizing your profits from ETFs. The first strategy is dollar or rupee cost averaging. This is the simplest strategy, whose benefits you receive in SIP investing. Meaning, if you invest in ETFs at irregular intervals, with regular investment value, you can average out the ups and downs of the market. This is because you buy more units when prices go down, while fewer units in higher price situations, thus averaging out the cost. SIP in ETFs is possible through most brokerages. The next strategy is a makeshift one that we call swing investing. This is borrowed from swing trading, which uses market momentum to buy low and sell high. But for investing, you don't want to sell in such short swings. Instead, what you can do is buy in downswings and hold. This way, you can actively buy at lower costs, especially for index investing. The limitation of this strategy is that you need to be aware of the swings and actively monitor the market even though you are not a trader. The last strategy is asset allocation based on ETFs. This is a simpler alternative for individual investors who cannot dabble in major assets together like equity, debt, and gold. ETFs will allow a low-cost balanced asset allocation strategy that takes care of the future by itself. For Indian investors, this can be good as equity markets are volatile, while also gold is a safe haven asset class that can be converted to physical gold when required for social rituals like marriage. So, which of the three is the best strategy in your opinion? Cost averaging, swing investing, or asset allocation? Go type your answer down in the comment section. Now, let's move on to the last part of the video. What should you do? Chapter 4, Do's and Don'ts for you. Individual investors can fall into traps if they don't look carefully. So, here we have some basic do's for due diligence and profit maximization, while don'ts protect from some traps. First are basic do's. Be careful about the charges on the ETF and the brokerage for trading such securities. Also, check the NAV of ETF before investing to see the gap between price and NAV. Lastly, check with your tax consultant if ETFs are beneficial for you from a tax aversion perspective. Next, let's move on to don'ts for ETF investing. The first major don't is to invest in ETFs with low liquidity and low AUM, or assets under management. Such an action can spell disaster as liquidity and AUM size provides safety against major market crashes and other risks. The next thing to look out for is ETNs, or exchange-traded notes. Do not invest in ETNs without knowing what are their underlying mechanisms and risks. Such a case is possible as ETFs and ETNs are sometimes confused with each other. The last don't is do not replicate the strategies given for ETF investing across asset classes, like stocks directly. ETFs, being a hybrid of mutual funds and stocks, can have these hybrid strategies, but stocks individually may not. So, these are basic measures of due diligence before you invest in ETFs. ETF investing strategies need to be tailored according to your needs, risk appetite, and investment portfolio. So, always be careful, as unlike mutual funds, here no disclaimer like read all scheme-related documents carefully or mutual fund investments are subject to market risks will be displayed on your TV. That brings us to the conclusion of the video. So what do we know? What have we learned? ETFs are hybrid investment securities that can provide the best of both, mutual funds and stocks. Various types of ETFs provide you different opportunities in terms of risk-reward ratio. Liquidity, passive or index investment, and low cost are attractions of ETF investing, while tracking error, brokerage charges, and the need for self-discipline are some limitations. Later, we learned about the top 3 ETF investment strategies, which are rupee cost averaging, swing investment, and asset allocation. We discussed how each can help you manage your risk-reward ambitions. Lastly, we discussed the basics, do's and don'ts for ETF investing to save yourself from traps and be on your way to making the most money. This brings us to the end of the video on ETFs. Don't forget to go down in the comment section to tell us and this community which of the 3 ETF investing strategies you like the most and why. Press the like button if you didn't and subscribe to this channel for more such content. Do you want to know more about how money works and want to maximize your investment returns? Then visit this video to the Psychology of Money book summary.